Alright guys, welcome back for another video. In today's video I want to talk about a little bit of the lower time frames, at least the intermediate term time frames. This will be an update to the Bitcoin Trading Journal series. If you haven't caught the previous update based on the weekly close, I would recommend checking that out. That's a little more high time frame analysis, probably actually a little more valuable for framing your bias. Uh, I like to start with the higher time frames first and then work my way down to the lower time frames. But I think there is some value in getting very granular in the way you look at price. And I want to do that now. So just to put things in perspective, I've anchored the chart, the left-hand side of my chart, to the quarterly open, right? What's the significance of the quarterly open? Well, you get institutions and funds are shoring up their quarter two profit and loss on their balance sheet, rolling up different funds. So you get this area that generally serves as a pivot. You get your July 1st open right there. That's the beginning of Q3. And, what do you know? You get to your quarterly open and then price changes behavior, right? It's coming off this downtrend in a very dramatic capitulation event. Sells off down into the quarterly close, you get a new quarterly open, and price starts running for liquidity to the upside, right? Running sell stops up here. So you can see this change in behavior kind of marked off by this X right here. If you move this right there, this X. And then you see price coming down for the lows and defending the lows and then creating new highs and sustaining that trend, right? And even on the lower time frames, seeing, even though you push far above this high right here, well, you got a lower time frame swing right here, right? You push above this high right here, run up, sell back into the high, run up, sell back into this high right there, run up, and then this is kind of how you base off here. But there's a way to play this, right? You don't necessarily get looking for the retrace as soon as price breaks through the high, because you don't know, like price can break through the high and then keep shooting and keep going forward. So you could generally, the way I would do it is mark off the consolidation that occurs sort of around that liquidity above there. So your liquidity above here is there because this is the area where people would set their sell stops, their buy stops if they're short. Price runs above there and tags it. But again, we don't know if it's going to stop there and keep, or keep going. It could always keep going. But then once it consolidates at that liquidity, sets in a very low time frame low, right? If you were to go down to the 5-minute time frame, there would be a swing within here. There's your consolidation low. Once that breaks, then you've got your liquidity run, your consolidation break, and then you can expect price to retrace the swing a little bit further. And then in this case, we see it defend the lows, run up. Each of these swings in here is tradable if you are interested in playing the low time frames. Again, this is a 4-hour chart, but you can even go down to the 15-minute and trade within this, right? Like this run up here, run down there, run up, run down there. And again, this is not exactly a great example of a liquidity run, but you do get this intermediate time frame area right here. You can mark this low off right there, right? Price runs up, comes down to this low, tries to rally, fails, breaks this level. Once that's broken, then this consolidation has failed to the downside and it's looking for more liquidity. Ultimately, it runs down to a 618 retracement right here. That's a 618 retracement from this low to this high up here. And you retrace all the way down right into that 618. Just great. A lot of times you'll see this behavior here. You'll see price tag the 618, run up, and then just sweep the stops below there. And if you were to go onto like a 5-minute chart, that would be a much more noticeable and distinguished stop run. But in here, you run down to the 618, pick up liquidity, and then just hit the gas. Of course, this was impacted by a data release, right? You had the CPI numbers coming in pretty hot at this point. Excuse me, not the CPI. This was the GDP data. Not the GDP data, but the FOMC meeting and the kind of data that they released there. And that kind of opened the door on price. Of course, generally that's what happens when when you have that kind of data event. Liquidity will dry up in the market, and people will uh, be a little bit more risk averse, which means they're not in the market, which means less liquidity. Now, in that case, I was pretty confident about this trade, so I actually opened a position just prior to the what would we call it, the FOMC data release right here. It ended up working out well for me. Now I'm in a 196 Bitcoin position, in pretty solid profit, looking at 458,000. So I just now I'm going off and just looking at the left hand side of the chart from the perspective of the FOMC data release, and you can see here that you get the same pattern that we were talking about before. Price runs up above here, and actually in the hourly you can see the distinction right here, right? This is actually a great example of a classic behavior. Um, you get this run above, and then price enters a distribution pattern above these highs, right? You want to sell here. It runs down, runs into this high right here, runs up, one last push above, slams back down in the range. Whenever you see that distinction, that's a major red flag, right? If you see price reclaim the high and you expect it to continue rallying, you want to see that happen pretty quickly on decent volume. But this is what you wouldn't want to see, right? This breakdown in back into the range, and then if you see price run liquidity like this, and then come down and slam back in the range, and then sort of hang out by the lows, it's probably gonna break the lows, and then yeah, exactly, that's what you see. These lows get broken here. Can be even a little bit more refined. We just use this high right here because uh, price came down, ran into that high, then that low is your area. Once it's broken, then it adds this resistance right there. Price, didn't come down to the 618. Remember, the 618 is based off this entire swing. So if you were to anchor it from up there, it'd actually be a little bit. Actually, wait. Let's see if that may be wrong about that. Actually, no. So yeah, it didn't hit the 618, but now we've got a new 618 up here. And the point I want to bring your attention to here is, again, we see the same pattern, right? You see these liquidity runs above the highs into these purple arcs I've marked off, and then sell off, and then sell into this base here. But you could get a another liquidity run, right? We've got the 618 right here, and generally, whenever you see a price distinction here that is confluent with a run of different lows, right? So price could run down to the 618 and stop out everybody who's got their stop loss right here. So that's a pretty significant level in my mind. Level I'd want to buy if price did go down there. So it's a long way of saying, kind of tying into what I had analyzed on the weekly chart, which may not, I haven't really gone through it on this video, but just to make a long story short, price could run down and run these lows right here, um, at 22377, and I wouldn't, I would still be buying it at that price level. Really, it was the roughly the 21666 level right here. So basically, the entry in my position at 21619. Um, any type of weekly close below that level, um, at that point, I would definitely abandon the position. I mean, it's not the end of the world. Their price may just go sideways, maybe retest the lows. Who knows? But definitely a lot of the bullish momentum would be gone if price did run down below the 21666 level. Anyway, yeah, it's just a little nuanced view of the charts. Again, just kind of different concept for people to contextualize liquidity runs. Remember, think about these highs right here, highs right here, highs right here. I guess the one thing that's really dangerous, and like if you got one thing out of the video, right, it's to understand what's happening in the market here and to not be on the side that's getting taken advantage of, right? You had this quarterly pivot here where there's a market structure shift, and then price is objectively bearish, right? Um, Especially if you're able to free your mind to consider that price can absolutely pivot at these pivots, and totally change their direction, and to the point where like um, none of the rest of the charts really matter, right? I mean, they will have an impact on price, but as far as like your bias, right? At least in my opinion, I found it helpful for me, to just totally drop my bias after every quarterly open, just because it's only going to hold you back, right? What's more important, right? If price is going to go down, right, it'll have to start breaking structure to the downside, right? So that's what's most important, right? What the most important thing in price is what's happening right now, not what's happened a couple months ago. That already happened, right? Something different is always happening. It's just really important to anchor oneself in the current moment. Of course, that's extremely obvious if you say it out loud, but you'd be surprised how many people don't actually incorporate that into their behavior and the way they trade. So I guess going back to the big risk is that after you get that shift in market structure, you know, people who are still holding on to their bearish bias, even though the market structure shift, well, every downturn, they're going to like look at this as like a prime area to short, right? So they would be shorting right here. And then price, appears to top out, and then, comes down here, and then they're shorting here, right? Or if price comes down here, it's just they're gonna pile in. They're gonna see these down moves as confirmation of a major swing high, and then start entering a short position. And that's really the worst way to trade this market. Really, the market is just generally can be said to be running the highs for liquidity. And if the market was going to switch around and start to trend down, well, then it would start doing the opposite, right? It would start, looking for liquidity to the downside. But you may say, but sir, you said, you'd be bullish if these lows got ran here. Well, yeah, that's actually a good question. If someone were to have asked it, um, and it's important to know how to anchor the range, right? What's important is that certain you've got this low right here, right? That was obviously very significant. If we put the volume on the chart, yeah, you can see that the volume that came in after the FOMC meeting was very significant, at least relevant to anything current. So really, that's like the big in this one as well too. But this is a smaller swing within this larger swing. So if you're just playing, you know, if you really just want to simplify uh, your analysis, I think I would it's important to be able to prioritize which low is important. And in my mind, that low from the July FOMC meeting is very important. Right? Again, going back to what we were saying, if the market does change or turn around, then it ultimately would run for liquidity below these lows, and would probably actually retrace a little bit after. If that were to happen, run liquidity down below here, and then bounce. But still, that then that bounce would be a situation where bulls are getting turned around too, right? And uh, that would just be, anyway, long way of saying that this is the invalidation point that I'm looking at. And of course, from a risk reward perspective, right, the reward gets better the closer price gets to the invalidation. Now, I was lucky enough to already have established a position uh, there, but and I don't really feel the need to take profit. But I guess what I'm saying is that if if I wasn't in a position and price were to return to that level, I would put on the same position and manage the position the same exact way as I am currently right now. Uh, but anyway, that's just my perspective. That's just the way I'm looking at this position. That's just the way I'm looking at the chart. It's not financial advice, just my opinion. But I hope you guys got some value out of it. If you did get some value, just make sure to subscribe to the channel. Every subscribe helps. And I'll catch you guys in the next upload.